September 29th, 2008. 6 hours and 32 minutes. That's how long it took for global markets to erase more than $1.2 trillion in value. The Dow Jones plunged 777 points in a single session, the largest point drop in history at the time. Traders stared at screens in disbelief. Phones rang without answers. Hedge funds froze redemptions. Pension funds bled. The world's financial system didn't collapse that day, but it cracked. Now fast forward to today. Because something just shifted in Japan, quietly, technically, almost invisibly, and it has recreated the same structural setup that existed before every major modern market crash. Not a headline crash, not a panic yet, a pressure build. And once these systems start unwinding, they don't unwind slowly, they snap. On the surface, it looked harmless. A modest move in Japanese interest rates, a routine bond market adjustment, the kind of thing financial news scrolls past in 10 seconds. But inside global markets, it hit like a stress fracture in a skyscraper's foundation, because for more than 3 decades, Japan has been the world's free money machine. Zero interest rates, sometimes negative rates, an endless supply of ultra-cheap borrowing. And global investors use that cheap yen to fund almost everything you see inflated today. US stocks, tech bubbles, real estate booms, crypto surges, emerging market rallies, borrow cheap in Japan, convert to dollars, buy risk, repeat. Trillions of dollars flowed through this mechanism. It became the hidden engine behind the longest asset boom in modern history. And now that engine is stalling. When Japan raised rates again, and when its bond market began violently repricing, it signaled something far bigger than a policy tweak. It signaled the end of the cheapest leverage the world has ever known. And history tells us exactly what happens when leverage unwinds. In 1987, it was portfolio insurance algorithms automatically dumping stocks. In 2008, it was mortgage leverage imploding. In 2020, it was margin and liquidity evaporating. Every crash looks different, but they all share the same core mechanics: overvaluation, a trigger, and a cascade. Right now, all 4 are lining up again. US stocks sit near historic valuation extremes. Automated trading dominates market volume. Debt across governments, corporations, and investors is at record levels. And Japan just delivered the trigger. Here's why it matters more than most people realize. When Japanese bond yields exploded higher recently, they didn't move like normal bond markets. They moved violently. Tiny amounts of trading erased tens of billions in value. That's not a healthy market. That's a leveraged system straining under pressure. It's the same signal we saw in US mortgage bonds in 2007. Small cracks, then sudden collapse. Because when yields rise quickly, every leveraged trade built on cheap money starts breaking. Hedge funds face margin calls, banks tighten liquidity, algorithms trigger sell orders, investors rush for exits, and selling feeds more selling. This is how crashes accelerate, not because people panic first, because the system forces liquidation. And Japan sits at the very center of that system. It is the largest foreign holder of US government debt. It is one of the biggest funding sources for global leverage. And it has been the backbone of carry trades for decades. When stress hits Japan's bond market, it doesn't stay in Japan. Capital gets pulled back home, US bonds get sold, stock markets lose liquidity, emerging markets bleed, the entire global risk engine begins reversing. And that's exactly what happened before Black Monday in 1987. Back then, markets had soared for years. Confidence was extreme. Leverage was hidden inside new financial products. Then a series of global shocks hit. Rising rates, trade tensions, currency instability. And once automated selling kicked in, the crash became unstoppable. Today, the mechanisms are faster. The leverage is bigger. The interconnectedness is deeper, which means the unwind, if it accelerates, will not be gentle. It will be violent. Already volatility is rising. Bond markets are flashing stress. Capital flows are reversing in emerging economies. These are not random movements. They are early-stage symptoms of a leveraged system beginning to unwind. Most people won't notice until stock prices fall sharply. But by then, the cascade is already in motion. This is why crashes always feel sudden. The pressure builds quietly, then releases all at once. And right now, the pressure is building in the exact same place it has before, inside leveraged funding markets. Japan's move didn't cause fear. It changed the math. And when the math breaks, markets follow. In the next part, I'll break down exactly how the yen carry trade works, why it inflated global markets for decades, and why its unwind could pull trillions of dollars out of stocks faster than most investors are prepared for. Because once you understand that mechanism, you'll understand why Black Monday 2.0 is no longer a wild theory. It's a structural risk already in motion. To understand why Japan's shift is so dangerous, you have to understand the trade that quietly powered global markets for over 30 years. It's called the yen carry trade. And for decades, it was the closest thing to free money the financial world has ever seen. After Japan's economy collapsed in the early 1990s, its central bank did something unprecedented. It drove interest rates to zero, then below zero. Borrowing money in Japan became almost free. Sometimes banks practically paid investors to take loans. So global traders did what humans always do when something is cheap. They used it everywhere. They borrowed massive amounts of yen, converted it into dollars, euros, and pounds, then poured that money into anything that paid higher returns: stocks, bonds, real estate, private equity, crypto, emerging markets. If US stocks returned 7% a year and borrowing yen cost nearly nothing, the profit was automatic. And if the yen weakened, which it often did, those profits grew even larger when converted back. It wasn't a risky trade. It was considered a structural advantage. Hedge funds built entire strategies around it. Banks funded portfolios with it. Institutions quietly relied on it as their cheapest source of leverage. Over time, the scale became enormous. Not billions, trillions. No one knows the exact number because much of it sits inside derivatives, swaps, and offshore structures. But estimates consistently land between $500 billion and over $1 trillion, directly tied to yen-funded positions, and far more indirectly connected. This trade didn't just support markets, it inflated them. Cheap money always does. It pushes investors into risk. It raises asset prices. It rewards leverage. And it creates fragility. Because when the funding source disappears, everything built on top of it starts shaking. For 30 years, Japan kept the system alive. Every time global markets stumbled, cheap yen financing helped stabilize risk-taking again. But that era is ending. When Japan began raising rates, even slightly, it changed the economics of this entire structure. Borrowing yen now costs money. And more importantly, the market now expects it to cost even more in the future. That expectation is what forces unwinds. Because leveraged trades don't wait for losses. They exit when the math turns against them. Here's what happens. Mechanically. An investor who borrowed yen to buy US stocks sees Japanese yields rising. Funding becomes more expensive. The profit margin shrinks. At the same time, bond volatility rises. Currencies begin moving faster. Risk increases. So the investor reduces exposure. They sell stocks. They sell bonds. They convert dollars back into yen to repay loans. That buying of yen strengthens the currency, which makes every remaining carry trade position lose money faster. That triggers more selling, which strengthens the yen even more, which forces more liquidations, and Japan's bond market just signaled that those waves are beginning. When long-term Japanese government bonds suddenly started swinging in huge price moves on tiny trading volumes, it revealed something critical. The same pattern appeared in 2007 before stocks peaked. In 1987, futures markets and currency stress showed trouble before the crash. Today, it's Japan's bond yields and the yen, different instruments, same structural warning, and the danger is multiplied now. Because algorithmic trading dominates modern markets. When volatility spikes and correlations rise, computers don't think, they de-risk. They sell across assets simultaneously, which accelerates every move. That's why modern crashes happen faster than historical ones. Speed plus leverage equals instability. And the yen carry trade connects nearly every major asset class together. When it unwinds, diversification disappears, everything falls together. Emerging markets, corporate bonds, all funded by the same cheap money source, which is now getting more expensive by the month. This is why Japan's move isn't just a local policy shift. It's a global funding shock. And it's happening at a time when markets are already stretched. Valuations are high. Debt is massive. Economic growth is slowing. There's no cushion, only leverage. In the next part, we'll connect this unwind to what's already happening inside US markets. Rising volatility, weakening liquidity, fragile confidence, and the growing probability that a single shock could turn this slow pressure into a full cascade. Because once funding breaks, markets don't drift down, they fall fast. While the carry trade begins unwinding in the background, something else is already happening in plain sight. Liquidity is thinning. The quiet force that keeps markets stable, the ability to buy and sell without huge price swings, is weakening. And when liquidity fades, even small shocks can cause massive moves. This is exactly what happened before every modern crash. In 2007, trading volume in mortgage bonds dried up months before stocks peaked. In 1987, futures markets became unstable before the selling avalanche. In 2020, treasury markets briefly froze before central banks stepped in. Liquidity always breaks first, then prices follow. Right now, warning signs are appearing across global markets. Bid-ask spreads are widening in bonds. Volatility is rising in currencies. Sudden price jumps are becoming more common. These are symptoms of stress, and Japan's funding shock is feeding directly into them. When investors pull back from leveraged trades, they don't rotate smoothly, they retreat, they hold cash, they reduce exposure everywhere. That reduction drains liquidity from the system, which makes every market more fragile. Now layer automated trading on top of that fragility. But during stress events, everything starts moving together. That's what we're seeing now. Bond yields jump alongside stock sell-offs. When the same money funded everything, everything moves together when it leaves. And the source of that money is the yen. As Japanese yields rise and funding costs increase, global investors are forced to de-risk. Another major stress point now forming is in government bond markets outside Japan. When Japan repatriates capital, it often sells foreign bonds, especially U.S. treasuries. Japan is one of the largest holders of American government debt, so when pressure hits at home, those bonds become a funding source. Selling treasuries pushes U.S. yields higher. Higher yields increase borrowing costs. Higher borrowing costs hurt companies, and falling company profits hurt stock prices. This is the transmission mechanism. Funding stress in Japan becomes market stress in America, which becomes economic stress everywhere. We're already seeing yields spike in sudden bursts, just like fragile markets behave before breaks. At the same time, corporate debt markets are flashing early warnings. Risk premiums are creeping higher. Investors are demanding more compensation to hold weaker companies. That's what happens when liquidity tightens, and businesses that relied on cheap financing start struggling. Historically, this is how recessions begin. Then consumption falls, then earnings collapse. Markets don't crash in isolation. They reflect economic stress building underneath. And that stress is now being amplified by Japan's policy shift. The timing couldn't be worse. Global debt levels are the highest in history. Governments are stretched. Corporations are leveraged. Consumers are pressured by inflation. There's far less room to absorb shocks than in past decades, which means even moderate funding stress can produce extreme outcomes. This is what makes the current setup eerily similar to previous crash periods. Strong markets, high confidence, hidden leverage, then a funding shock, then cascading stress, then sudden collapse. And the most dangerous phase is the one we're in right now, the phase where prices haven't fully broken yet, but the structure underneath is weakening rapidly. This is when most investors remain optimistic. This is when dips still get bought. This is when people say everything is fine. That exact psychology existed in 1987. It existed in 2008. It existed in early 2020. The crash always feels impossible until it suddenly isn't. And what makes this moment even more precarious is that central banks are no longer in a position of unlimited rescue. Inflation remains elevated. Interest rates are already high. Debt servicing costs are massive, which means the traditional response, flooding markets with cheap money, carries far greater risks than before. The safety net is thinner, the system is tighter, and leverage is higher. In the next part, we'll walk through exactly how a full unwind could unfold, and step by step, from a single shock to a global sell-off, and why the speed of modern markets could turn weeks of stress into days of collapse. Because once these cascades begin, there's rarely time to react. Now let's walk through how this pressure turns into a full market cascade. Because crashes don't begin with panic, they begin with mechanics. It starts quietly. Japanese yields rise again, funding costs edge higher, volatility picks up. At first, only the most leveraged players react. Hedge funds trim positions. Banks tighten risk limits, algorithms reduce exposure, stock prices wobble. Nothing dramatic yet, just weakness. Then the yen begins strengthening faster. Carry trade losses accelerate. Suddenly, what was a small funding issue becomes a profit problem. More positions get closed, selling increases, bond markets react next. Treasury yields jump as foreign holders liquidate. Higher yields hit mortgage rates. Corporate borrowing costs rise. Stock valuations compress. The market starts falling faster. Now margin calls begin. Investors who borrow to amplify returns are forced to post cash. Some can, many can't. So positions are liquidated automatically. Selling feeds, selling. Volatility spikes. Risk models across banks and funds flash red. Exposure limits trigger. More forced selling. This is where algorithms take over. Modern trading systems are designed to protect capital. When volatility explodes and correlations rise, they exit. Not slowly, instantly. Stocks, futures, options, ETFs. Entire portfolios are reduced in milliseconds. Liquidity disappears. Prices gap lower. This is the moment crashes go vertical. It doesn't feel like a gradual decline. It feels like the floor vanishes. Circuit breakers may pause trading, but when markets reopen, fear meets thin liquidity, and prices fall again. This is exactly what happened during past crises. Pauses didn't stop selling, they compressed it. Now, layer in human psychology. As screens turn red, investors who had stayed calm suddenly rush to exit. Retirement accounts get shifted. Stop-loss orders trigger. Media headlines escalate. Fear spreads faster than reason. And that fear accelerates every mechanical pressure already in motion. At this point, the crash is no longer about Japan. It's about liquidity. When everyone wants out and nobody wants in, prices collapse. Because leverage connected nearly every asset class, losses appear everywhere. Stocks plunge, corporate bonds freeze, real estate trusts sell off, emerging markets tumble. Even traditionally safe assets can wobble as investors scramble for cash. This is why crashes feel global. Funding stress doesn't respect borders. It transmits through capital flows. And the yen carry trade sits at the center of that web. Once it snaps, the shock moves everywhere simultaneously, and what makes this cycle particularly dangerous is the scale. Global asset values are far larger than in past decades. Debt levels are higher. Derivatives exposure is massive, which means forced selling now impacts trillions in minutes, not billions over days. This is why modern market drawdowns are sharper and faster. Speed amplifies leverage. Leverage amplifies losses. Losses amplify fear, and fear amplifies selling. It becomes a self-reinforcing spiral. At some point, authorities step in. Central banks inject liquidity. Governments issue reassurances. Emergency programs get announced. So, how do you know when pressure is turning into panic? History leaves clues. And those clues tend to appear in the same places every time. The first is the yen. When funding stress accelerates, the yen strengthens rapidly as traders rush to unwind carry trades. Slow moves are normal. Sharp moves are danger. A sudden surge in the yen is one of the earliest signals that leverage is breaking. It means global investors are scrambling to repay borrowed money, and when that happens, risk assets rarely survive intact. The second signal is volatility. Markets can drift lower quietly, but crashes announce themselves through exploding volatility. When fear rises faster than prices can adjust, it shows up in sudden spikes. That's when algorithms flip from trading to protecting. And when that shift happens, liquidity disappears. The third is bond market stress. When government bond yields begin making large, fast moves instead of gradual ones, it tells you something is wrong beneath the surface. Healthy markets absorb pressure. Fragile markets amplify it. Violent repricing is the fingerprint of leverage unraveling. The fourth is credit. When investors start demanding higher returns to hold corporate debt, it means confidence is fading. Easy money becomes selective, then scarce. And when credit tightens, economic slowdowns follow. The final signal is correlation. When everything starts moving together, diversification stops working. That's the moment funding stress is spreading across the entire system. Stocks, bonds, currencies, and risk assets all reacting at once. It's the hallmark of forced selling. When these five align, crashes are rarely far behind. Not because anyone wants one, because the structure makes it unavoidable. Now zoom out. Look at the environment today. Markets sit near historic valuation extremes. Debt levels across governments and corporations are the highest ever recorded. Automated trading dominates volume. Leverage underpins asset prices. And the world's cheapest funding source is disappearing. This is the same setup that existed before Black Monday in 1987. Different tools, same mechanics. Then, portfolio insurance created automatic selling loops. Now, algorithms do it faster and across more assets. Then, rising rates and global imbalances triggered stress. Now, Japan's funding shift is doing the same. Then, leverage magnified every move. Now, leverage is even larger. History doesn't repeat perfectly, but it rhymes with alarming precision. That doesn't mean a crash happens tomorrow. Unwinds can stall, they can grind, they can flare up suddenly. But when structural pressure builds this way, outcomes tend to be violent rather than gentle. The system doesn't slowly release leverage. And in extreme cases, a full-scale panic reminiscent of past financial crises. Which path unfolds depends on speed, policy response, and whether additional shocks hit at the wrong moment. But what's clear is that risk is no longer low. The easy money era that supported relentless asset inflation is ending, and transitions of this magnitude are rarely smooth. For everyday investors, this isn't about predicting the exact day of a crash. It's about understanding the asymmetry. When markets are stretched and leverage is high, the upside tends to be limited, but the downside can be swift and severe. Gains come slowly, losses come fast. That's the reality of fragile systems. Periods like this reward caution more than optimism. They reward risk awareness over blind confidence. They reward preparation over panic. No one rings a bell before markets break. The warnings appear quietly, in funding markets, in volatility, and correlations. And by the time headlines scream crash, the damage is already done. Black Monday didn't feel inevitable the Friday before it happened. Neither did 2008, neither did 2020. They only felt obvious in hindsight. Right now, the same structural forces are lining up again. Japan's shift wasn't just a policy tweak, it was a crack in the foundation of global leverage. And cracks in financial systems tend to spread, not slowly, but suddenly. Whether this becomes a manageable correction or something far more severe remains to be seen. But the setup is there. The pressure is real. And the risks are higher than most people realize. If this breakdown helped you understand what's happening beneath today's market calm, consider subscribing for more deep dives into the forces shaping the global economy. And share your thoughts below. Do you see this as a temporary wobble or the beginning of a larger unwind? Thanks for watching. And stay prepared.